John Ferguson of Princeton Developments, in conjunction with the Jaroslawski Chair in Finance, a chair in the Alberta School of Business occupied by my colleague, Dr. Randall Mork. Now, as most of you know, the school celebrated its centennial last year, commemorating 100 years of excellence, relevance, and impact. And not only was it an opportunity to honor our past, but more importantly, we at the school rededicated ourselves to the goals of an exceptional learning environment driven by outstanding research and incomparable opportunities to engage with and uplift our communities. Today's lecture is an example of that commitment and to our focus on leadership, which is the foundation of our vision, embodying our long heritage and dedication to creating leaders from Alberta for the world. I'd like to now recognize some of the honored guests and leaders in attendance today, and I'd ask you to hold your applause till I've announced all the names. The Honourable Anne McClellan. From the Government of Alberta, Carl Amrine, Deputy Minister, Alberta Health. Curtis Clark, Deputy Minister, Alberta Education. Andre Corbu, Deputy Minister, Environment and Parks. Shannon Marchand, Deputy Minister, Alberta Seniors and Housing. David Morhart, Deputy Minister, Human Services. Donovan Young, Deputy Minister, Indigenous Relations. From the City of Edmonton, Councillor Bev Esslinger, Councillor Ben Henderson, and Councillor Andrew Knack. From the University of Alberta, Chancellor Douglas Stollery, President David Turpin, Provost and Vice President Academic Stephen Dew, Board of Governors member Leroy Johnson, and Chair Emeritus of the Board of Governors, as well as a former member of the Board of Directors of the Bank of Canada, Brian Heidecker. And representing the Ferguson family, Brad Ferguson, President and CEO of Edmonton Economic Development Corporation. Welcome all. The University of Alberta respectfully acknowledges that we are located on Treaty 6 territory, traditional lands of First Nations and Métis people. And this acknowledgement is all the more significant this week and today, as we all confront our world's challenges of discrimination, isolationism, and violence. Friends, the goal of the Princeton Lecture Series is to focus on today's economic issues by bringing leading authorities to the University of Alberta and to Edmonton to discuss and share their professional insights about Canada's economic and business future within a global perspective. And I can think of no better person for this role than today's distinguished speaker, the Governor of the Bank of Canada, Stephen S. Poloz. An economist by training, Mr. Poloz first joined the Bank of Canada in 1981 and occupied a range of increasingly senior positions over a 14-year span. He then spent 4 years at BCA Research as managing editor of its flagship publication, the International Bank Credit Analyst. Mr. Poloz joined Export Development Canada in 1999 as Vice President and Chief Economist, and from 2008 to 2010, he was responsible for all of EDC's lending programs, as well as the economics and corporate and international trade intelligence groups. He became EDC's president and CEO in January of 2011, a position he held until his appointment at the Bank of Canada in 2013. Ladies and gentlemen, please join me in welcoming Governor Stephen Poloz.
Well, thank you very much, Joe, for that introduction, and thanks to you, everyone, for being here. I certainly appreciate that warm welcome. It's a pretty chilly day. On the U of A campus, just across the river, the Alberta School of Business sits a couple of hundred meters east of the Centennial Centre for Interdisciplinary Science, which of course houses a number of telescopes. Now, when you look at a star through a telescope, you see it not as it exists today, but as it existed years in the past, when its light started heading towards Earth. And in that sense, a telescope is something like a time machine. Now, if only those telescopes could do the opposite and see into the future, then economic forecasting and policymaking would be a snap. But since we don't have a machine that lets us see the future, we have to make do with the next best thing. the crystal ball. And that's a real crystal ball. But seriously, not the crystal ball, the economic model. Now I don't know what to do with my crystal ball. There we go. So the economic model is the modern day equivalent, I guess. Models have become indispensable to the conduct of monetary policy. And that's basically because central banks are usually using monetary policy to target a variable, such as inflation, in the future. Policy actions take time to affect those targets. So to illustrate, it takes up to 2 years for a change in interest rates to have its full effect on inflation. And what that means is that there's very little point in reacting to the latest movement in inflation. Instead, central bankers need tools that can forecast where inflation is likely to be 2 years from now and tell them how to adjust policy today so inflation will hit the target then. So, of course, economic models are not crystal balls. They generally explain what happens in the economy on average. Models always make errors, but the errors are supposed to cancel each other out over time. Now, the fact that models can deliver only an approximation of the truth means that conducting monetary policy is not a mechanical exercise. It's a complex blend of art and science, in effect, an exercise in risk management. And sooner or later, something extraordinary happens to the economy that a model can't explain, pushing the model persistently off track. And a forecaster can rationalize a string of prediction errors for a while and adjust his or her judgment around the outlook accordingly. But eventually, the time comes to rebuild the model. And the global financial crisis of 2007-2009 is one such event. It's a very significant outlier in our economic history. And models have struggled to explain the forces that led to the crisis and the behavior that followed. And this experience is now guiding the work of today's model builders. In the bank's most recent medium-term plan, we identified as a core priority the need to reinvent central banking, in part by refreshing and upgrading the tools that we use. Now, the cycle of modeling, forecasting, and remodeling is as old as empirical economics. It's actually how we make progress. Well, today, what I'd like to do is review the history of models at the Bank of Canada, illustrating how each generation has built on the successes of the previous generation and adapted to the changing needs of policymakers. So I'll describe how economic theory and computer technology have enabled this evolutionary process. And I'll speculate about what we can expect in the next generation of economic models. Now, a key issue in building economic models is the trade-off that exists between forecasting ability and theoretical rigor. Forecasting models focus primarily on capturing those empirical regularities. They work well when the economy and the shocks that it faces don't change much over time. But in contrast, theoretical models built for policy analysis are based more on a specific interpretation of how the economy functions. And so their specifications may hold true on average or over long time periods, but certainly not for every data point. So models with a strong theoretical base tend to underperform empirical models in normal times. But they can be very useful in explaining behavior when large shocks cause those database models to break down. So the two types of models have tended to be complementary historically. But that's never stopped economists from pursuing the holy grail of a single model that combines strong theory with good empirical performance. Over time, advances in computing capability have made it possible to build more realistic behavioral assumptions into models and improving that trade-off. However, the history of model development at the Bank of Canada reflects both this quest for a grand synthesis as well as the evolving needs of policymakers. Each new model is drawn on the strengths of its predecessors while addressing their shortcomings. And throughout this history, advances in both economic theory and computer technology have played that important enabling role. Now, the bank began modeling in the 1960s. Now, I'm looking around myself, I'm seeing hardly anybody that remembers the 1960s. Well, that's all well and good. But the staff at the bank and visiting academics, professors, built the first model, which was called RDX. That stood for Research Department Experimental Model. Experimental. That sounds pretty cool, eh? So the development of the mainframe computer was essential to this work. Not every institution had one, including us. So one academic who was involved in those early days at the bank, John Helliwell of UBC, has some pretty good stories from those days. He can tell stories of sending boxes of punch cards by bus to a computing center at the Université de Montréal, and also inputting data on a modem to a computer in Utah in order to run the models. Well, we've come a long way since then. Now, the early models used by most central banks are based on Keynesian theory, with the demand side of the economy driving growth. But the inflationary experience of the late 60s showed the importance of also modeling the supply side, which led to the bank's successor model, RDX2. Now, just to give you some idea what economists of the day were working with, here's the manual. I got props today. Here's the manual that spells out the equations in RDX2. Yes. That's an antique, by the way. We're lucky they let us take that out of the library. So, after the oil price shock of 1973-74, the bank wanted to use its model to examine alternative policies to manage the situation. So the bank actually began targeting the money supply, which was de rigueur at the time, as a means of reducing inflation and anchoring inflation expectations. That was in 1975. But RDX2, the model that I just showed you, didn't have the ability to compare alternative policy paths. So this led to another investment. It led to the development of RDXF, where F denotes forecasting. So this version of RDX2 was much more amenable to policy analysis, and of course the acquisition of an in-house mainframe computer greatly facilitated the work. And this is the model that was being used for quarterly projections when I arrived at the bank in 1981. Now, I can vividly recall my initial disappointment with RDXF. So I was fresh out of grad school, when the natural rate hypothesis and rational expectations were de rigueur. The natural rate hypothesis holds that there's no permanent trade-off between inflation and unemployment. Instead, the economy settles at full employment in the long run. Inflation reflects the impact of monetary policy actions and people's rational expectations. Rational expectations were seen as key to anchoring both the models and the economies, as well as critical for properly analyzing alternative policy paths. So the gaps between RDXF and the thinking of the day became even more real a couple of years later when the bank dropped its monetary targets and began the search for a replacement policy anchor. Specifically, we believe that RDXF would be very vulnerable to the Lucas critique. Now, the Lucas critique, it's fairly common sense, was that empirical models based on data that are generated under a given policy regime and with a given expectations formation process would prove to be unstable and forecast poorly when the policy regime changed. So by the late 1980s, the bank was converging on targeting inflation directly as the central goal of monetary policy. And what this meant was that monetary policy making would put much more focus on the future. We needed a model that would allow the bank to make detailed projections, not just over the next couple of quarters, but for at least 2 years into the future, to reflect the lag between interest rate changes and their ultimate effect on inflation. So this thinking led to the development of a new model, SAM, the Small Annual Model. Well, here's the manual for SAM. It wasn't really that small. We measure them by the thickness. It's about 1 inch thick. It wasn't really that small, but it was small in spirit. SAM incorporated the natural rate hypothesis. It also defined a steady state to which the model would converge after being hit with a shock. But the flip side of these theoretical strengths was that SAM was not suitable for short-term forecasting. So what we did was we used SAM to complement RDXF and use them together. And the longer-term plan was to use SAM as a prototype to build a quarterly model that had those same strong properties, and this would replace RDXF. So eventually, QPM, the quarterly projection model, was built. It incorporated forward-looking consumers and companies with rational expectations. It had a coherent, steady state. Its short-term dynamics fit the data well enough to be used for projections. It even embraced all the stock flow dynamics that are necessary to analyze the significance of rising government debt, and that was a prominent issue at the time in the early 1990s. The QPM represented a huge leap in sophistication, and the desktop computers that we had at the time weren't up to the task. As the chief of the research department at the time, I had to make a special request of then Governor Gordon Thiessen for money to buy special, more powerful computers just to run the experimental model. And even with those, he approved, by the way, the process lasted all night. The computer would work on it all night. Well, QPM served the bank well for more than a decade. And its only real major shortcoming was that it couldn't deal with shocks to Canada's terms of trade, essentially fluctuations in the prices of key commodities like oil, which of course today we're very familiar with. These shocks would become larger and more frequent in the Canadian economy, so adding a commodity sector to QPM moved to the top of our project list. And at the same time, the economics literature was shifting to yet a new class of models, DSGE, which stands for Dynamic Stochastic General Equilibrium. So DSGE models capture the idea that economic behaviors, decisions about household consumption or business investment, are perfectly informed, forward-looking, and optimal, driven by micro-foundations. So these models also predict how an economy can evolve over time as expectations change. Stochastic shocks are built into the model from the start at the household and firm level, and that therefore deals completely with the Lucas critique. So the model solution describes an economy that has reached a state of general equilibrium with individual decisions, all those individual decisions, aggregated into economy-wide prices and production quantities. Well, that sounds ambitious. Well, the bank decided to make a major investment to build Totem, the terms of trade economic model. And Totem kept all that functionality from QPM while adding the commodity sector, and it was based on the DSGE paradigm. Once again, this experiment at the beginning proved to be too much for the standard workstations that staff had on their desks, despite their increased power. Calibrating Totem required an extremely complex series of mathematical problems that took up enormous amounts of computing power. So believe it or not, the solution during the prototype stage was to buy some top-end gaming computers to crunch the numbers on nights and weekends when the heat and the noise wouldn't make people's offices unbearable. Well, Totem continues to work extremely well for us for both projection and policy analysis. Now, of course, Totem's foundations represented a shift toward the theoretical side of that trade-off that we talked about before between forecasting ability and theoretical rigor. So bank staff built a new model designed to complement Totem and guard against different types of forecast risks. So this is the large empirical semi-structural model, which we call LENS. And LENS operates under a different paradigm than Totem. It's based more on the data and has only a loose set of theoretical constraints. So it acts as a cross-check for Totem. And the staff use those two models together to develop their projection on a quarterly basis and to facilitate a dialogue around our policy options. So in this way, the bank is managing the trade-off by using two complementary models simultaneously, much as we conceptually did with RDXF and SAM. But Totem and LENS are much closer together in performance than RDXF and SAM were. and that reflects the improvements in that trade-off that I mentioned before. Well, this approach proved to be extremely valuable. I'll give you a case study. In late 2014, and Canada was faced with this collapse in the price of oil. Now, in contrast to standard Keynesian models, Totem anticipated just how serious the oil price shock would be, how the effects would endure, how the dynamics would unfold, how the economy would adjust to lower oil prices. And our confidence in this analysis led the bank to lower its policy rate twice in 2015, long before those negative effects of the oil price shock began to be widely felt. And that put a cushion under the economy and made for a faster adjustment to the shock. Now, together, Totem and Lens represent a powerful, modern approach to economic modeling at a central bank. Nevertheless, they provide very little insight into the forces that produced the global financial crisis or the behavior that has come afterward. And this is true for all major models previously used by central banks. The period since the crisis has raised related questions that these models aren't well equipped to answer. For example, how will this prolonged period of low interest rates affect risk-taking behavior in the economy? How are business confidence and geopolitical uncertainty affecting business decisions? How do global value chains affect the way monetary policy is transmitted? Now, to be clear, Totem and Lens have continued to do a good job despite these shortcomings. And to complement them, we've developed a number of satellite models, smaller models to deal with specific issues. An illustration, the bank has built a model called MP2. That's called the macroprudential and monetary policy model. And so that's to study the impact of financial shocks and macroprudential policies on the economy. Other models look at the ways inefficiencies in financial markets can lead to financial imbalances. There have also been ambitious modeling efforts to understand exports at a very granular level in light of extensive destruction of export capacity over the past decade. So this multi-model strategy has allowed us, I think, to successfully mitigate the limitations of the current generation of models and appropriately manage the risks facing monetary policy. But the next generation of models at central banks will need to address these issues directly. Now, no one can say with any certainty what the next generation of central bank models will look like, but we can expect them to stand on the shoulders of models like QPM, Totem, and Lens. Now, one lesson we've learned over the years is that a single model is unlikely to satisfy all of our needs. And this is a consequence of the fact that models are, by construction, an abstraction from reality. And striking that right balance between theory and data fit is more an exercise in judgment than it is an empirical one. And those judgments are best informed by drawing upon complementary models. Now, another lesson that we've learned is that central banks have traditionally stuck with their models until well after their best before date. Now, there's no doubt because greater realism in models means greater complexity, more computing power, big investment in research and people. These are the things that slow down the development of new models. But guarding against keeping a model too long may mean continuously investing in new approaches, even when there are no obvious shortcomings in existing models. Indeed, it's often in the unforeseen advances in modeling paradigms enabled by improved computer technology that drive modeling progress. So today, the DSGE paradigm appears to have a long future, but no one was even dreaming of that approach when we were building QPM 25 years ago. Now, to illustrate, an alternative approach worth exploring may be agent-based models. Now, unlike the DSGE approach, agent-based models assume that the economy consists of individuals who repeatedly interact with each other and adapt their behavior based on what they learn. And macroeconomic behavior only emerges naturally from those interactions. So those kinds of models have their own limitations. But in a world where there's big data and where advertisements you see online can be derived from what you type into your search engine, agent-based models could be a very valuable tool. But the next generation of models is also likely to take a more nuanced approach to expectations, specifically rational expectations. In reality, people seem to behave in a way that falls somewhere between full rational expectations and what we call rules of thumb. Hence the promising concept of bounded rationality. Another potentially desirable attribute in future models is to allow for more forms of heterogeneity. We know, for instance, that different companies make different decisions about when to enter or exit markets, when to invest, how to invest. And we know people with different income and wealth levels respond differently to interest rate movements. And we know that these responses can change depending on the person's stage of life. Well, many financial transactions occur simply because people have varied risk tolerances. But most current models assume uniformity among companies and among individuals. So at a minimum, the next generation has got to capture these, and it's got to capture the links between the financial system and the real economy. They should explain how the financial system can be a source of shocks and how those shocks can be propagated. You need to capture the possibility of nonlinearities that cause small shocks to have outsized economic effects. And they should be able to show how debt that builds up in a specific sector can affect the entire economy. And we need models that capture risks and vulnerabilities within the financial system and can show how these interact with monetary and macroprudential policies. Well, that's not an exhaustive list, but it illustrates my point that we have some work ahead of us. Bank staff have been given a license to innovate on these issues because we know model evolution takes time, and we should invest continuously in it. Now, before I conclude, I want to return to an issue I raised at the beginning, and that's the role of uncertainty in policymaking. It's tempting to think that we can use today's sophisticated models to give us a precise numerical inflation forecast 2 years from now, and to use those models to develop the exact policy response that's needed today to keep inflation precisely on target. In earlier speeches, I've likened this process to an exercise in engineering. Well, in fact, economists do exactly that with their models. But then they express their predictions in more probabilistic terms. They point to the many margins of error that exist around all the relationships and the variables in their model, all the assumptions that they must make, and admit that their ultimate calculation contains all of these sources of error by construction. Now, this creates uncertainty around both the model's inflation forecast and its recommended policy path. So at the bank, we think of this inherent uncertainty as creating a zone within which our interest rate setting has a reasonable probability of bringing inflation back to target over a reasonable time frame. So this sort of uncertainty exists even when models are performing well. But there are additional uncertainties, including those related to model disrupting structural changes, such as those that were triggered by the global financial crisis. These additional uncertainties may introduce a bias in the model's projections and make it more likely that its suggested interest rate path will lead to missed inflation targets. And of course, there is uncertainty generated by the risks to our inflation forecasts. So we begin our interest rate deliberations with the policy path recommended by our models, but we're always mindful of the uncertainties, including the range of risks that might cause us to undershoot or overshoot our target. All of these sources of uncertainty define that zone, the zone in which we can be reasonably assured that policy is on track. Factors that increase uncertainty, such as geopolitical risks, can widen this zone temporarily. Conversely, resolution of uncertainties can narrow it. And this is the essence of the bank's risk management approach to monetary policy: interpreting, weighing, and managing those risks approaches art. But the art is built on the science of our models. So allow me to make three related points. First, the starting point matters to a monetary policy decision. If inflation is on target, is projected to be on target in 2 years, then various risks that we identify can be interpreted and managed in an even-handed manner. But our current situation serves as a counterexample. While we project that inflation will be sustainably at target around the middle of next year, we're well aware that the lingering aftermath of the crisis has left the Canadian economy with persistent excess capacity, and that inflation has been in the lower half of our target range for some time. The second, the uncertainty in economic models makes it ill-advised to reduce the conduct of monetary policy to a simple mechanical rule. The fact that there are so many sources of uncertainty, some of which cannot be quantified, makes the risk management exercise highly judgmental. A corollary to that is that we need to explain our underlying reasoning very carefully to ensure that it is well understood. And to this end, the bank has taken a number of measures to increase its level of policy transparency in recent years. Third, uncertainty does not equal indecision. Now, it's true that the notion of a zone generated by uncertainty can create a degree of tolerance for small shocks. At the same time, a large shock, or perhaps an accumulation of smaller shocks, can tilt the balance of risks to projected inflation and prompt policy action. So going back again to early 2015, Totem was showing how the oil price shock would play out, and the downside risk to projected inflation became unacceptably large. So the shock pushed us out of the zone, in which the existing interest rate setting provided reasonable assurance of hitting our inflation target within a reasonable time frame. Accordingly, as mentioned before, we reduced interest rates to bring projected inflation back into line with our target. So it's time for me to conclude. The bank has been pursuing inflation targets for 25 years, and the average rate of inflation has been extremely close to target over that period. Now, this alone suggests that our models have done their job reasonably well. While our current models continue to perform well, recent experience is pointing to some shortcomings that we need to address. Given how long it can take to develop a new model, investing in the next generation of models is one of the bank's top priorities today, and I want it to be a top priority for the economics profession as well. Better tools will mean a more stable and predictable rate of inflation and an even better environment for economic decision-making. This is one of my key messages today. And since this speech is being broadcast nationally, please let me repeat it in French. Bien que nos modèles actuels restent performants, l'expérience récente a fait ressortir certaines lacunes que nous devons combler. Étant donné tout le temps qu'il faut pour élaborer un nouveau modèle, l'une des priorités de la Banque est d'investir dans la prochaine génération de modèles. Et je souhaite que l'ensemble des économistes en fassent également une priorité. L'amélioration des outils nous permettra de maintenir l'inflation à un taux plus stable et plus prévisible, et elle facilitera la prise de décisions en économie. It's an exciting time for economics and monetary policy. Personally, I can hardly wait to see what comes next. But I know economists have a tendency to get overly excited about their own issues. So let me leave you with an analogy to help you keep this all in perspective. So today's macroeconomic models are as different from those of the 1970s as the latest Star Wars film, Rogue One, is from the first of the original trilogy, A New Hope, which was released in 1977. So no matter which film you prefer, it's clear that the tools and the technology available to the director have evolved dramatically. The state of the art today is light years ahead of what was state of the art 40 years ago. But ultimately, storytelling remains what is important, and that hasn't changed. Our economic models will continue to evolve. They'll become better and more sophisticated tools, but it will always be up to central bankers to use these tools as well as their judgment to conduct monetary policy, achieve their targets, and offer a compelling narrative that everybody can understand. I thank you very much.
We have time for some questions, and I'll direct the questions loosely, so if you want to raise your hand, one at a time. Yes, Josh.
Thank you much, Joe. Thank you much. Made a few notes. Appreciate that. Thank you. Under the new Trump global regime, how did these models affect the Bank of Canada? It's going to drill you with like whack of questions, and I'm sorry to put you on stage, literally, but you're there, and I've been that guy, so I sympathize. Especially as it relates to our current investment environment and foreign capital investment. And like I said, a series of questions, so it all comes around to a point of what would you advise for business and investors today, and how have your models been renewed, shifted to national state versus globalism?
Okay, there was somebody over here that had their hand up. Okay, well, I'm going to stop you there, and I'll try to deal with that. So of course, for us, this is a question of not really knowing what's to come. So in our last monetary policy report, which is only 2 weeks ago, we tried to incorporate some of the more likely fiscal actions that seem to be receiving a fair degree of support in Congress. Because we want to acknowledge that those fiscal actions could have important impacts on Canada. But the things you're mentioning around trade policies, globalization, et cetera, remain very hypothetical things from this point of view. By the way, the analysis of the fiscal actions certainly showed a meaningful impact on the U.S. economy. But one of the reasons why we went to this trouble was to show how the analysis of its effect on Canada is not automatic. And so, in fact, there are a number of offsets that prevent much of that action to spill over onto the Canadian economy. Of course, there's the likelihood that an infrastructure program, for example, would have a strong Buy American component to it. So that's an obvious offset. But some that are less obvious, perhaps, are the fact that since the new administration entered the scene, we've had a pretty good backup in global bond yields. That's affecting our mortgage rates already, which is already, if you like, a source of slowing in the Canadian economy, which is, actually quite premature given that we have so much excess capacity compared to the U.S. economy, which is somewhere near full employment. The exchange rate, the U.S. dollar has risen, taking the Canadian dollar with it. Okay, so against other currencies, the Canadian dollar is getting stronger, quite a bit stronger. And that, of course, is another headwind for our exports. So taking these kind of offsetting effects into account, a shock on the fiscal side in the U.S. is having, and we model it to have perhaps 1/5 the extent. In other words, almost non-existent effect on Canada. So that's an important piece of analysis, but of course it's only a hypothetical for now because we don't really know what the fiscal stance will look like, so we'll remodel it as we go along. But for the other things that you mentioned, we've put them into what we call the risk category. We can't model them and without knowing what they'll be. And frankly, even when we know what they are, they'll be very complex questions. So you change the trade infrastructure or architecture some way. Companies on two sides of the border will adapt differently. Different companies will adapt differently. So a simple illustration, if you're in a manufacturing company with say a 5 or 6% profit margin, you may be able to clip your profit margin and still go on like before. Depends on what the policy change is. Or it may change your mind about investing in Canada. You may choose to invest in your U.S. operations or a new U.S. operations as a defensive or hedging measure. So those two responses are equally possible. So you can't assume them in order to quantify how these things might affect Canada. So it's still going to be, if you like, a complex forecasting exercise once we have more knowledge on what changes will occur. And then there's still going to be uncertainties in the risk set. So the way we think of it now is uncertainty has risen. It's in the wake of the election. And that is likely to feed through to investment thinking. That, usually uncertainty causes investment to hesitate or to slow down while we're waiting for more clarity. So far, the surveys suggest otherwise, that there is a certain amount of positive sentiment percolating out there. But we're not sure if that means companies are ready to invest, period, or invest in Canada, or invest in their U.S. operations. So it's a little bit unclear. I know that's not a complete answer, but I could go on at length, but I think I should stop there. Okay, well, we'll see if somebody else has an easier question.
I want to ask about the Canadian dollar. A couple of weeks ago, you were talking about the slack in the Canadian economy, and therefore we might have a weaker Canadian dollar, especially from the manufacturing, but for the benefit of Canada. And then about 10 days ago in the Wall Street Journal, the President Donald Trump had a comment that he thought the U.S. dollar was too high. And I'm just wondering, are we starting a run of the currencies to the bottom? And what do you think that might have an impact on the interest rates both in the States and in Canada?
Well, that's a pretty big question. I wish there was another question. But seriously, it's the honest answer is we simply don't know. But we do know that, as we discussed actually a whole year ago, I gave a speech in January, and it was about the coming policy divergence, and that still holds. Okay, we were at the time analyzing the oil price shock. See, if we go back 2 or 3 years, we weren't too far away from the dynamics of the U.S. economy, and we were headed home to full capacity, probably by around now. But the oil price shock meant about a 2-year, possibly 3-year delay in that process. So as we modeled it, it was a 2 to 3 year adjustment process after the shock. And so that's a setback, and it gave us excess capacity that has persisted and will persist, according to our models, probably until around the middle of next year. So that excess capacity puts downward pressure on our inflation. It means that we need interest rates to be low to counteract that and bring us back to full capacity to get inflation back on goal. Well, in the U.S. case, they're reasonably close to full capacity, as you can tell from everything that's being said. And so the U.S. is kind of out in front of everybody. And so, usually, exchange rates kind of follow that. If you're the economy with the weakest growth, your exchange rate will tend to go down. And if you're the economy with the strongest growth, it'll tend to strengthen. And that's what's been happening in the market, not just since the election, but for a much longer period. It's been that divergence has been clear. So all I was doing a couple of weeks ago was reminding people that we do have excess capacity, that in fact the rise in the U.S. dollar is against all currencies, and even if Canada holds steady, it means that Canada is rising against lots of other currencies. Mexican peso, for a good example. And what that means is our exporters are competing with other sellers in other economies trying to sell to the United States, and they're losing competitiveness, even though our exchange rate with the U.S. is not really moving much. So it's third country effect. And so that's an important headwind, and especially since exports has been one of our big issues, that exports haven't really picked up as much speed as our model suggested, and we've had to remodel it and put a bunch of new research out a couple of weeks ago. So long story short, we're still quite some ways behind the U.S. economy. And so a divergence in our policies is exactly what we would expect to see. We would not expect to see Canada following the United States at this stage in terms of monetary policy.
here. Sorry, we've got a mic for you.
I didn't realize there was a mic. I have a question about what you were talking about today in terms of modeling and whatnot.
Yep.
So one of the things that people have got consistently wrong since sort of the Great Recession has been, for instance, the global growth has been a lot slower than people expected.
Yep.
And then also interest rates have taken forever and they just don't seem to be coming up.
Right.
So what in terms of the modeling has been getting that wrong there in terms of, the long run versus the short run?
Right. So our belief is that the principal reason behind this is that the legacy of debt that was built up prior to the financial crisis, and then the crack up that occurred during the crisis, leaves an overhang of fragility, uncertainty, and of course debt to work on. So it's been observed in past financial crises that if cycles are caused by financial crisis, the economy takes much longer to repair itself and get back to normal than most of the cycles we've been through in our lifetimes have been. Interest rates go up, there's a down cycle, then interest rates go back down again, and the economy goes back kind of like an elastic band. So you get this globally, right, a global effect that everybody shared in. That was the most synchronized global downturn ever that we had in 2008, 2009. And there was a coordinated policy response to it. And so those who have observed that, models haven't really done a good job of explaining the slow recovery, are missing. It's models that miss the things I'm talking about. It's those stock flow interactions, which the level of debt matters. And not just government debt, perhaps, but household debt, and also the uncertainty. So if you talk to a firm, say, why haven't you invested? You seem to be doing pretty well. Well, I'm still worried. I barely managed the Great Recession, so my board's not ready to approve a major new investment yet. And it's like this. So we call that uncertainty, but it's really crushed animal spirits. And you're all kind of waiting for the animal spirits to turn positive again. And so people have said to me, well, it looks like policy doesn't even work. Like, you got interest rates really low and not much is happening. And so the quick answer to that is, so do you think if I moved interest rates back to, say, 3 or 4%, nothing would happen? Well, no. Most people think that would cause a huge slowdown, maybe a recession. Well, yes, that's the recession we're preventing by having those low interest rates. So my metaphor is when you're riding a bike up a hill, it may feel like you're getting nowhere, but your legs are telling you you're doing a lot of work. And if you need convincing, all you have to do is stop pedaling and see what happens. Thank you.
That's a good storytelling answer.
Yes, well, thank you.
Thanks for your presentation. 30 years ago, I worked with the Federal Reserve System, and I played with the economic model of the Federal Reserve in 1984, 85, and 86.
And you say that like that's a really long time ago. And I started at the bank as a summer student in 1978, so there.
But what was interesting, what struck me about your presentation is you put economic modeling and macroeconomic modeling in such great historical perspective. And I wonder if I had heard your presentation back then, if I had chose a different career and gone for a PhD in macroeconomics, right. Which leads me to my question. What can we at the University of Alberta and other universities across Canada do to produce better students and better graduates, because I know there are a lot of students here and parents of students here that could go to work for the Bank of Canada or the World Bank or other major policy-setting institutions. And so what are the things you are looking for, and how can we, adapt to help develop better modelers, for instance?
Well, that's a great question. I don't know if there's a specific thing to do, because what we really need is kind of open-minded folks who have exposure to specialties, but know how to adapt to different specialties. That is, they're technically adept and widely read and able to be nimble and pursue something that may be just a black hole may not work, but that's okay, because a lot of this stuff is of that sort, just as in other disciplines. There are experiments that just don't work, but we learn a lot from them anyway. And so I just think that what matters more is that you help develop an interest in the practical side of this. And, you know, in the last few years, it seems there has been a lower level of interest, you know, in the practical side of policymaking. The genre of models we're in, policy doesn't have a strong place. And what I hope to motivate by working through that uncertainty piece, so people understand policy has a very important place. It requires excellent, wide-ranging judgment, not just technical expertise. And so, and I also wish there were more women who would study economics. So you can do some more of that, that'd be great. But the fact of the matter is, statistically, the pool of women in the economics population, especially macro, seems to get smaller and smaller at each stage, from BA to MA and down to PhD. So having a diverse workforce at the central bank is definitely a challenge for us. We work hard at it. Anyway, thanks for your question. I don't have concrete. Just keep up the good work, and tell them how exciting it sounded. You know, that you would have for sure done that if only you'd known how exciting it really is. You know.
Jim Carter, and then this gentleman here, and this gentleman here. So Jim.
Thanks for coming and sharing your views with us today. My question goes back to your very good description of the chronology of your development of your models, and I'm wondering how you build into your sensitivity analysis or whatever you do around emerging technology. Things like, for example, the Internet of Things.
Yeah.
It's going to have a big impact on our businesses in Alberta, big data, analytics, what that's going to mean for the deployment of capital and the efficiency of capital going forward.
Yeah. So, you know, in a macro model, these things all kind of end up being in a residual, which we model. We call it productivity. Okay. And it is a residual. It's not fundamental. Capital deepening, of course, is modelable, but these kind of leaps in technology, which, you know, if you look back at the history of the computer chip, you think, well, you would have predicted 35 years ago a giant leap in productivity from it, but it took like a whole generation for it to become truly pervasive. And so predicting the timing of those things is just beyond our abilities. And so I think it's more about being acutely aware of how those things are affecting and focusing on what I call it the anecdote, the power of the anecdote. So I spend, extra time just talking to companies, CEOs, like to understand, what are they doing and where's the productivity and the cost cutting, where's it coming from? In my experience, productivity is just about everywhere I look, except in the statistics, which is only proof that it's really hard to measure this stuff. And it's particularly hard when companies straddle borders. They've got these bits and pieces going back and forth, and the growth in the services, which is so much harder to think in terms of productivity. So I'm confident that actually companies are doing a lot. It's just really hard for it to show up in the traditional macro stats that we look for. So what that means then is that the trend line, so when we say the economy will converge on a growth trend line of approximately 1.5%, that assumes we're going to have 0.5% productivity growth in the economy, which is lower than the historical average. So there's chances for it to be higher, but we need to see it before we assume it. And the other 1% just comes from labor force growth. And most of that, or a good piece of that, comes from immigration, because we're all getting older and the population growth from our existing population is really slowing. So those are the three ingredients, and the things that you're talking about will inevitably bump up that trend line. It could be something razzle-dazzle like the Internet of Things, 3D printing or so on like this. Or it could be something more basic like an interprovincial free trade agreement, which we think would add 0.1 or 0.2 to that. That's real money that you would add to that trend line. Or CETA, over a 5-year period can add another 0.1 or perhaps 0.2. These things, this is like free money lying around for us to pick up if we put those kinds of structural changes in place. And I think that in a world where growth is, hoping for 2% growth doesn't sound very ambitious given what we've been through. And yet it is very ambitious given the environment that we face. So the lower that number is, don't you think the benefits of adding 0.1 or 0.2 to that number seem much larger than they have in the past? So usually it's some sort of constraint that's, either consensual or political or something, So it's just hard to reach an agreement, but I think the ability to do so is probably improving through time. That's my hope. Thanks for your question.
You made reference to gaming computers for the computing horsepower they offered. So I'm curious,
it was just it was an experimental model, so it was an inexpensive thing instead of some fancy workstation. So.
I'm curious to get your thoughts on your capacity to model and how that's changed with technology and what you foresee as the capability that's on the horizon in terms of what you can model and the factors that you're going to include going forward.
Yeah, I mean, Moore's Law has so obvious in our business. And so now, everybody has a workstation that can solve totem, like in a blink, okay? Whereas back then, we would set it running on the gaming console, gaming computer, and it would run all night or maybe even all weekend to solve out. And so that's just, mind over matter. I feel like you're really tricking it to do it. So that capability has gone up exponentially. And of course, you never really I never imagined that we'd be running DSGE models on our desktop. And, so whatever it is that we go to next, I probably can't imagine that either. But I'm confident that computer power is no longer going to be the constraint. Okay, it's more about what sorts of complementary models do you develop to help inform you in the blank spots that you don't understand well. So I mentioned agent-based models. So imagine a model where there's 100,000 individuals in it, and they're just trying to work and spend their money, and the macro relationships emerge out of the patterns of interaction. And then you introduced, a constraint around mortgage requirements, and it changes their behavior. So, the simple question of, the new rules around mortgages, how will they affect the economy? It's a very hard question to answer because everybody's response is a little different. Will I buy a smaller house or no house? Will the guy selling his house cut the price? Will it be just the same number of sales of houses as before? Will they just build smaller houses? There's a range of possibilities, but those kinds of models can give you more of an insight into how individual behavior will react. So that's kind of a gap in our abilities right now, but the computers are capable. So anyway, for now they are.
We have time for one last question.
I have perhaps the easiest question for you today.
That'd be great.
So as you're talking about the massive increase in computing resources available to the bank for developing models, how has the bank changed, or what changes have gone on with the human resources that the bank puts to this endeavor over the last, compared to maybe 20 years ago, and the educational backgrounds of those resources that you're hiring and applying to it?
Right. So I compare it mainly. I guess the best comparison for me is around 35 years ago when I graduated. So, I mean, the new folks that show up at the bank. I mean, the stuff that I thought was state of the art, they're just sort of like, oh yeah, that, oh, that. So, you know, I mean, and of course, managing to stay up with even a small bit of the literature through your life is hard enough when you have a daytime job, right? And so that's just, to me, it's amazing to talk to these folks about what they think can happen or what we can do. And their specialties are a huge range, from the exotic to the basic. It's a highly international team. Not enough PhDs in economics from Canada in macro, and so we have recruited a number of folks from outside of Canada. So there's a really cool diversity in that respect too. They all follow different literature. So it's hard for me to generalize in what's happened. I think it's just that the literature has advanced at such a pace, and the folks that you hire in have been immersed in it, for the last 6-7 years or whatever. And it's what happens when they get together. So, I'm always amazed when I just ask what I think is a fairly ordinary question at the thoughtful stuff I get back. It's not, I was expecting a back of the envelope, well, if this is this big and that's that big, then it'll be like this. And what comes back has so much more the ring of sophistication, and I think, yeah. And by the way, I did the back of the envelope, and it should be not too far away from that. So you got to still have that cross-check kind of common sense thing going. But I don't know what else to say. It's just they're completely different, just like today's Star Wars movies compared to the 1977 Star Wars movies. So is that the last question?
Would you like another one?
Yeah, because that was a lame answer.
Gentleman with the red tie. Do we still have the mic?
How are you incorporating in your model the effect of what I would refer to boutique domestic policies? An example would be, for example, the foreign buyers tax in BC.
Yeah.
So what sort of so obviously I'm assuming that the direct modeling the direct impacts of those are clear, but what about the sort of modeling the broader impacts? And if you've done things like that, how have the models sort of held up between the empirical data you have and what you expected from the models?
Right. So highly specific shocks like that would not have a normal place in your standard macro model. So this is what I was alluding to when I talked about satellites. So you need to think, well, okay, we need to construct a forecast for housing. We do that every time, and it's well modeled, but it doesn't have that thing in it. So let's take it out, in effect. And so well, if we could add that just to a housing block, what effect might it have? And as I said a few minutes ago, it can have a range of possible impacts, and the model gives you a list of possible magnitudes. So what that then does is allow you to say, well, since it exists, that allows us to shade our judgment, because we're never judgment-free. So when we got the model, every data point, we were starting today to do a forecast, your latest data point is not on your model, right? And so you're starting with, I need a story around why my model is under or over the latest data point. And do I just make it go back to the model right away, or does it take a few months or quarters to get back? That's the judgmental part. So everybody's working with their own sector that way and telling a narrative around why that would be. And this sort of thing, they'd use a satellite model to populate that and say, okay, well, that's the way this worked in Singapore, the way it worked in Hong Kong, it did this, and the other thing. And so we believe that something like this would be a reasonable expectation. And so they'll build that into their judgment line in the housing part of the macro model.
So these models tend to be very siloed in that sense? Like, for example,
Well,
the example I gave, what were, you have models sort of the ancillary effects. So
Yeah.
what were the total investment, not simply in housing,
Yeah.
in residential housing in Canada before that from places, for example, like China,
Yeah.
but investments in like businesses?
Yes.
Do you model the effects in other aspects where that, those are boutique policies
Yes.
sort of influence people's decisions?
Right.
And so do you have your model sort of say, okay, this is where we expect them, and then do comparing sort of like, the total inflow of capital before that policy and the total inflow of capital after that policy, not just in housing, but in other related areas?
Correct. So, but the conversation would begin with the policy shift, which is in, the person that's running the housing narrative, would be the focal point of that analysis. And then we'd be saying, well, now how do we put that into the macro model, and what other places should it have an interaction? There'll be a certain amount that will happen through the GE process. But for example, international capital flows may need to be remodeled to capture that. So you kind of would have a list of 4 or 5 places where you'd need to address it in your model. And as I indicated, it would need to be judgmental, but that judgmental step can be fueled by, almost quick and dirty modeling around on the sides, the satellite space, and say, or review the literature, any other examples of this that fuel that. And so then that judgment would get inserted, and then you run the whole model. So you're capturing all the interactions of it. And you say, oh, geez, why is this happening? Oh, that's traced back to this. If we just change that back to 0, you can see, shock minus control, how that policy is affecting all the other things that you're looking at. So that's why you need a model, because it's hopelessly complicated. And you only need to take, like I said, 3 or 4 places where they're the most prominent places, and let the GE take care of the rest for you. And again, when you're done, you say, but I'm assuming this, and this, so those are all kind of assumptions that could change over the next few months. So I've got to inject a certain amount of extra humility or uncertainty or probabilistic conclusion around what I'm telling people is likely to happen. And so generally you'll see us express that as a range of possibilities. And so we monitor the real data, and either it falls into line or we have to, rethink. That's the real art, because there are no mechanics to save you. You just don't have that kind of level of granularity in a macro model.
Governor, thank you. We're going to be able to continue the discussion with refreshments in just a minute after I do the thank yous. But I do want to thank you very much, and I want to assure everyone that that last question isn't on the test. Governor,